In this lesson, you will learn about equity valuation. By the end of the lesson, you should be able to describe the concepts of fundamental, technical, and quantitative equity analysis. Explain valuation methodology, including replacement value, applications of time value of money, and market multiples. Calculate sustainable growth, and discuss the meaning and application of market multiples. There are two major schools of thought regarding the big picture about equity investing: top-down analysis, which you investigated last lesson, and bottom-up or fundamental analysis. In this module, we will focus on bottom-up analysis. Fundamental equity analysis is a bottoms-up approach. Rather than trying to forecast the economy, the investment manager is looking for good companies. For example, those companies with strong earnings and cash flow growth, excellent return on equity, competent management, etc. It's the kicking the tires approach. Once identified, the value of the enterprise can be determined and compared to the current market price. If the price is less than what the company is worth, then it's a buy. If the company is overvaluing, or if the market is overvaluing the company, it's not purchased or perhaps shorted. Then it's just a matter of waiting until the market recognizes the mispricing. The CFA Institute is an internationally recognized organization promoting fundamental analysis. You can access their website at www.cfainstitute.org. There are three primary methodologies for determining value. One, the replacement value. This is the value is equal to the cost of recreating an identical business. Two, the discounting of future free cash flows. The value of the business is equal to the stream of cash you will receive adjusted for risk and time. And three, market comparables. The value can be found by applying comparable market multiples to company financials in order to determine value. Question: how do you assess the replacement value of an ongoing concern? Unfortunately, the answer is with great difficulty. The problem is that a going concern is much more than just the bricks and mortar. You must consider not only replacing the facility, but the workforce, customer list, goodwill, intangible assets, etc. For this reason, replacement value is quite difficult to use and not normally used for financial assets. Rather, replacement value is commonly used when valuing real estate, where intangibles are not a big piece of the valuation. For example, in valuing a real property, the building cost per square foot, current land value, and other extraneous costs can be added together to produce a meaningful number. Well, what about book and liquidation values? Are these meaningful valuations? The book value of a company is a historical balance sheet item. This value is equal to total depreciated assets minus total liabilities, i.e. the total shareholder value. The book value doesn't account for the current cost of replacement. Liquidation value is a fire sale item. It's more of a floor than a relevant measure of value. It is a number that describes a dismantled business, not a going concern. Practically the only time this value is useful is in the event of a bankruptcy, where assets are to be divided up and sold. Time value of money is a core concept that runs through all investment in corporate finance. Time value of money tells us that the value of a company is equal to the present value of future cash flows. And this is the most theoretically correct methodology for valuing a going concern. Free cash flow is optimal. However, earnings and dividends are often used as a proxy. Remember, financial analysts have the responsibility of projecting quality, future cash flows and for determining the appropriate discount rates. As with any analysis, the result is only as good as the numbers used, i.e., garbage in equals garbage out. Management has the discretion whether or not to return earnings to shareholders in the form of dividends. However, once they decide to issue dividends, they send a signal to the market that the policy will continue. Two important ratios are the payout ratio, which equals total dividends divided by total earnings, and the retention or plowback ratio, which equals 1 minus the payout ratio. Let's work an example that focuses on these two ratios. Question: what is the dividend payout ratio and the plowback or retention ratio if the net earnings for the company were $250,000 and $185,000 were paid out in the form of dividends? The payout ratio is calculated by dividing $185,000 of dividends by the total net earnings of $250,000. 74% of earnings are paid out in the form of dividends to common shareholders. If 74% are paid out, then 26% are retained. These dollars flow into the balance sheet and are booked as retained earnings. Dividend growth rate is a product of the firm's return on equity and plowback or retention ratio. Of course, management could elect to increase the payout ratio. However, holding that payout constant, dividend growth is described as dividend growth G equals the plowback ratio times return on equity. Consider this example. The return on equity equals net income divided by shareholder equity, and in this case we're saying it's 25%. The plowback ratio we calculated is 26%. Therefore, dividend growth equals 25% times 26%, which equals 6.5%. Let's now verify this growth rate by working through the numbers. This work will take the mystery out of growth equals retention ratio times return on equity. First, let's remember that return on equity is equal to total net income divided by shareholder equity. You were given the total net income was $250,000 and the return on equity is 25%. Rearranging the ROE formula, you can solve for shareholder equity. Return on equity equals total net income divided by shareholder equity, which equals total net income over ROE, which equals $250,000 divided by 0.25 or 25%, which equals $1 million. You already solved that the payout ratio on the $250,000 of income was 74%, and that meant that the plowback was 26%. So 26% of the $250,000 of current net income is $65,000. That $65,000 flows into the retained earnings. So now the new shareholder equity is $1,065,000. Holding that the company earns a 25% return on equity, the new earnings are 25% times the $1,065,000, and that equals $266,250. Also maintaining that the dividend payout is 74%, the new dividends will be 74% of that $266,250, which equals $197,025. When you compare the new dividends to those from last period, you can work through the growth rate. In this example, you have an increase of $12,025. And you get that by subtracting the $197,025 minus last year's $185,000. Dividing $12,000 0.025 by 185,000, you discover the growth rate is 6.5%. That's the same growth rate as multiplying the return on equity percentage times the plowback ratio. Okay, as you just discovered, the dividend growth rate is simply the return on equity times the retention ratio. Sustainable growth is a term used to describe the growth in shareholder equity. It is calculated the same way. Sustainable growth equals the plowback ratio times the return on equity. So now, let's work through these numbers to verify. Given the following, the retention rate is 26%, the old shareholder equity was $1 million, and the current net income is $250,000, and the plowback or retention ratio is 26%, you can easily solve for the amount of money that will flow to retained earnings. $250,000 times $26,000 equals $65,000. Goes to retained earnings. The new shareholder equity equals $1,065,000. The growth percentage would be $1,065,000 minus the original million divided by 1 million equals 6.5%. That's the same growth rate as multiplying ROE times the plowback. Or as you remember, 25% times 26% equals 6.5%. As you have discovered over the last 4 slides, when holding the payout and retention ratios constant, the growth rate of dividends is really driven by the amount of money reinvested back into the business. Of course, the reinvestment must generate the same return on equity to generate that growth. Otherwise, the return on equity for the company will decline if it's below it, or it could go up if it's higher than it. A commonly used valuation approach is to value an asset based upon the selling price of a comparable asset. Market comps are always applied in the valuation of real estate. Market multiples, especially price to earnings, are also routinely used on Wall Street. Market multiples show the relationship between the price of an asset and some factor, for example, sales, or earnings, or cash flows. A company's current multiple can be compared to itself over time, to that of competitors, or to industry averages. Commonly used multiples for equity valuations include price to earnings, price to sales, price to cash flow, price to book, price to R&D, or the PEG ratio. These multiples are generally good measures for established companies and industries. But what about companies without any earnings or sales? What happened when internet companies appeared on the scene with no cash flows or earnings? The answer is that new measures were developed or focused on for comparative purposes. Rather than book value or earnings, investment in research and development, number of page hits, the subscriber growth, for example, were used as comparative measures. Any logical related measure of success can be compared to the price, and that multiple can then be compared to itself, competitors, or industry averages. The price to earnings ratio, PE, describes the relationship between the market price per share and the firm's earnings per share. It is an important multiple that's followed and quoted by financial analysts and intermediaries. Consider the following example. The price per share is $24, the earnings per share is $3, therefore the PE ratio is 24 divided by 3, or 8 times. 8x means 8 times earnings per share. If the $3 earnings per share was earned last period, then the 8x is referred to as a trailing multiple. If the $3 of earnings is a projection for the upcoming period or the period after that, then it's referred to as a forward multiple. Higher PE ratios are typically associated with higher growth prospects. Investors are willing to pay a higher multiple because once that growth is realized, the price may be reasonable. Remember, the market is a discounting mechanism. Let's walk through the example your textbook author presented regarding two companies offering the same current dividend but possessing different growth rates. In the textbook example, the first company is expected to earn $5 and the entire amount will be paid out in dividends. That means the plowback ratio is equal to 0% and the sustainable growth is 0%. The second company is expected to earn $5. However, 60% of the earnings will be retained or plowed back into company operations, earning the same amount on equity percentage, the same amount on return on equity percentage. This equates to a sustainable growth rate of 9%, i.e. the sustainable growth equals the ROA of 15% rate times 60% plowback, which equals 9%. The value per share for the first company using a no growth dividend discount model is equal to $40 per share, i.e. that's $5 divided by 12.5%, right? 0.125. The PE multiple would be equal to 8x. That's $40 divided by 5. The value per share for the second company using the constant growth dividend discount model is equal to $57.14. That's the $2 dividend payout divided by 3.5%. That's the 3.5 comes from the 12.5 adjusted by the 9% growth rate. The PE multiple will be equal to 11.4x. Another way of looking at this example is to just break apart the value of the second company as the value of the constant growth or the constant payout plus value of the growth prospects. As you see, present value of the growth prospect is $17.14. This demonstrates the important learning point that reinvestment back into the company, i.e. the plowback, at a rate that matches or exceeds the company's return on equity represents value. And as a discounting mechanism, the market should assign a higher PE multiple for that growth. The PEG ratio describes the relationship between the PE ratio and the firm's earnings growth rate. For example, market price per share of $24, earnings per share of $3, company growth rate equals 15%. Therefore, the PEG ratio, which compares the PE ratio, 24 divided by 3, to the growth divided by, in this case, 15, that equals 0.53. This ratio is a useful indicator that shows how the market is currently pricing a stock compared to its expected growth rate. A PEG ratio of 1 means that the market is pricing the stock at its growth rate. PE of 15, growth rate of 15, therefore 15 by 15 is 1. A PEG ratio below 1 implies the market is undervaluing the growth because it is selling below its growth rate. A PEG ratio above 1 implies potential overvaluation. You already heard that market multiples can be used for self-comparison purposes. What does that mean? It means you can compare the current multiple of a stock to its historical range to get a sense of how the market is valuing it. For example, if shares of a stock are selling at 4.5 times cash flow, do you think the price is expensive or cheap based on the chart depicted here? Well, the graphic shown on this slide indicates that the company has traded in a range of 4x and 8x cash flow. Based on current valuation, the company appears to be very reasonably priced. The motivation for purchasing a security when its multiple is priced in the lower portion of the historical range is based on the concept of reversion to the mean. Although markets can be quite efficient, stock prices tend to trade above and below intrinsic value because of market sentiment, i.e. market optimism, market pessimism. In periods of optimism, prices trade above the value supported by the underlying fundamentals. Perhaps that is because expectations for future cash flows are just too rosy. On the other hand, during periods of pessimism, prices will trade below what fundamentals suggest the company is worth, particularly from a long-term perspective. The concept of reversion to the mean implies that prices will eventually trade back to intrinsic value, i.e. a value justified by the long-term cash flows. It is a concept that supports portfolio rebalancing. For example, in the late 1990s, value stocks were sold off as investors flocked to growth stocks. After 2000, the value stocks sold off and money flows were back to value names. There was a reversion to the mean. Often, the market multiples at which competitors are selling are applied to company financials to determine a reasonable market price or used to assess over and undervaluation. Comparability implies that the companies have similar risk and liquidity issues, similar cash flows, similar growth prospects, and similar capital structure, and possibly in the same or similar industry. Let's look at an example. In this case, you're attempting to price shares of the CA company based on market multiples. You've identified two comparable companies and the industry average. That information is depicted on the chart. Okay, the first step might be to analyze the relative strength of the CA company in relation to the competitors in industry. And by relative general strength, we might be talking about strength in terms of return on equity, company earnings, leverage. Well, based on that information as given in this example, the CA company generates a ROE near the high end of the range and an above the average earnings growth rate. Both of these are positive. Its capital structure is somewhat riskier than average. The higher risk would lower the multiple somewhat. The next step is to select the multiples that will be applied for valuation purposes. The multiples on this table seem reasonable based on higher return expectations, but with higher risk. However, you may elect to change them somewhat. The final step is to apply the multiples that you've identified to the financial data and the projections for the CA company. Notice that you did not obtain one price. Rather, you obtain a range of prices. In this case, the two income statement driven multiples, price to sales and price to earnings, show that the equity would be priced in a tight range of $28.90 to $29.70. The one balance sheet multiple, the price to book, values the company at $22.88. As an analyst, you would have to answer the question, is book value a relevant valuation item for this company? So let's summarize some observations to this point. Valuation is very sensitive to the financial inputs, e.g. dividend growth rate, free cash flows, forward rates, projected sales. Therefore, analysts must use reliable, quality numbers. 2. Valuation is a moving target. It depends on the growth prospects, the discount rates, and market sentiment. Now let's move on to the subject of technical analysis. The premise behind technical analysis or chart reading is that everything the market knows, public and non-public information, is contained in the price action of the stock. Therefore, there is no need to conduct fundamental analysis. Just locate stocks that have positive technicals, where money is flowing in, and invest in that security until the charts indicate otherwise. The Market Technicians Association, MTA, is an international recognized organization promoting the study of technical analysis. Technical analysis includes the study of price, volume, time, chart patterns, and sentiment. Some examples of these specific technical indicators follow. In the area of price and price derivatives, you might look at the price change, the trend, support and resistance levels, overbought and oversold oscillators, and trading bands. Realize that items like over or oscillators and trading bands are simply manipulations of price. In volume, you may focus on normal levels of volume versus current levels of volume and total market breadth. Some example of technical indicators regarding time, pattern, and sentiment are shown on this slide. For time, you may be doing cycle analysis, fractal analysis, or look at seasonal patterns. Some common chart patterns include head and shoulder tops, double bottoms, triple bottoms, flag formations, pennants, cup and handle breakouts, triangles, and gaps. Sentiment is another important area in technical analysis. You might look at mutual fund cash positions, market reaction to news, the number of bullish advisors. This chart depicts some price and derivative of price data, and you'll notice trend lines and some price derivatives, relative strength, overbought and oversold oscillators. This chart depicts some additional price and derivative of price data. You see a moving average. The moving average is designed to take out some of the daily noise. These averages can be arithmetic or exponential. Regardless, the purpose of the moving average is to get a less volatile measure of the overall price trend. The oscillator shown below depicts a faster and a moving average. When the faster moving average crosses over the slower, the technical trader may indicate a trade based on the assumption that there is a change taking place. Volume is a quite important aspect of technical analysis. It is said that stocks fall of their own weight. However, for stocks to increase in price, there has to be volume pushing it up. As such, there's some weight put on a move that's confirmed by volume on the upside. Chart patterns are thought to develop because of consistent human emotion. The patterns of fear and greed repeat themselves, and as such, the technician looks for patterns that seem to appear and reappear. In this chart, support and resistance in a double bottom are depicted. An excellent explanation about support and resistance was presented in a book in which they talked about World War I trench warfare. The attacks and the counterattacks continue between trench lines until one trench is overrun. When that occurs, it's referred to as a breakout, and we show a breakout on this chart. Once breached, a new resistance line develops at a higher price, and the price level that was overrun becomes the new level of support. On this chart, you see that the stock traded in a range for nearly 3 years. A double bottom, a common psychological aspect of trading, is pictured here. In this example, the stock sold off following the market collapse of 2000 until it reached the low teens. At that point, buyers came in and the stock rallied. Following the 9/11 sell-off, the stock traded all the way back down to where it had rallied before. Buyers were confident at this point, and they are willing to come in at this level. Double bottoms appear. Not only that, you'll see triple bottoms. The quantitative investment manager uses the power of the computer to sort through the entire universe of stocks in order to narrow down the lists of prospects. For example, if you want to focus on small cap stocks and strong earnings growth and a return on equity in excess of 15%, it's easy to do with a quantitative analysis. Perhaps your search narrows down the list of 5,000 stocks to 500. To get that list down further, the manager might add stocks selling between $10 and 20 cents, or small caps with insider buying. Multi-factor models are constructed and back-tested to see how the portfolio stocks would have performed in a subsequent period of time. The models are run on real-time data, and the sort ranks ideal clients. These clients can be analyzed for possible inclusion in the portfolio. There are a variety of fundamental, technical, and valuation factors that quantitative sorts can be based on. A factor model may include some of the following: fundamental indicators such as cash flow growth, dividend yield, earnings per share increases, sales growth, return on equity numbers. Technical indicators, price changes or relative performance, volume, oversold measures. You can include valuation indicators, some of the market multiples that we've looked at today, and possibly some specific stock indicators. For example, need to see insider buying, a certain level of beta, market capitalization. So you see, the quantitative sorts allow you to efficiently use the power of the computer to sort through a wide range or a wide number of securities to get it down to a manageable group. At that point, you can start to apply fundamental analysis. In this lesson, you learned about fundamental equity analysis, technical analysis, and quantitative sorts. Valuation methodology, including replacement value, applications of TVM, and market multiples. Sustainable growth, and the meaning and application of market multiples.